Hello and welcome everyone to our webinar titled COVID-19 Legacies in a Post-Pandemic World. Thank you for joining today. Before I hand it over to Oliver, our moderator today, there are a few housekeeping points that I'd like to cover with you. At the bottom of the webinar screen, you should see a toolbar. Use the toolbar to access a range of applications such as the webinar, the speaker's biography, the technical support, or the resources available. Click on an application and it should open on your screen. All applications are resizable and movable, so feel free to move them around and get the most out of your screen space. Please submit your questions throughout the webinar via the Q&A box, and we'll try to answer those towards the end of the webinar. For the best viewing experience, we recommend closing any programs or web browser sessions running in the background. This will help conserve your bandwidth. The webinar is being streamed through your computer, so for the best audio quality, please make sure your computer speakers or headsets volume is turned up. Some networks cause slides to advance more slowly than others, so logging off your VPN is recommended. If your slides are behind, pushing F5 on your keyboard will refresh the page. Most of all, we value your feedback, so please do complete the pop-up survey at the end of this webinar. Without further ado, let me hand it over to Oliver.
Perfect. Thank you very much, Sophie. So welcome everyone, and thanks for joining us on today's webinar. My name is Oliver Dancel-Fisher, and my job is to make sure that our clients have access to the most useful economic and ESG data with which to base their business, policy, and investment decisions. So today's webinar is a thought leadership webinar, and in it we focus purely on the business impacts of COVID-19. This is important because arguably at no point in the last 100 years has business had to adapt so quickly and suddenly to an external shock such as COVID. Now, I know that many of you are probably thinking the title COVID-19 Legacies in a Post-Pandemic World isn't now really fitting, especially with the new COVID variant, questioning the whole notion of a post-pandemic world at this point in time. However, a lot has happened in the last 18 months, especially within the business community. So now would be a fitting time to stop, reflect, and take stock of some of the more enduring aspects of COVID-19 that could continue to shape the business world for years to come. So I think without further ado, let's meet our speakers. So we've got Serdar from the OECD. Welcome, Serdar. We've got William from BNP Paribas, and we've also got Claire, who works with us within the London Stock Exchange Group. So Claire, I think maybe let's start with you. Maybe take 30 seconds to introduce yourself, some of the work you do at LSEG. Floor is yours.
Thank you, Oliver, and delighted to be part of the webinar. Apologies that I can't be seen on camera. I've got a few technical challenges, unfortunately. But I had the pleasure of being head of our sustainable finance team in the capital markets division of London Stock Exchange Group. And what that means is it incorporates a number of different business divisions, including our LSE PLC, listed company business or trading, and our foreign exchange business. So really, I'm looking at sustainable finance primarily through the lens of our corporate advisory clients, helping to support companies as they navigate listings on the stock exchange and so the rise of the green economy that we see there happening, and also to support those businesses that are on market as they transition to low carbon economies. And we do this very much through the multi-asset class offering that we have from the capital markets perspective and the financing that can be raised, but also, more increasingly working with our colleagues in Refinitiv around data capabilities and how we can ensure that companies are articulating the right data strategies with investors to make sure that they are attracting that ESG capital that's available.
Perfect. Thank you so much, Claire. So William, as Group Chief Economist, maybe share a little bit about yourself and the sort of work you do.
Yes, well, thanks for the opportunity to be on this panel. Group Chief Economist of BNP Paribas. I'm from Belgium, based in Paris. I'm leading a team of about 20 economists. We are covering advanced economies. Then we also have a country risk team, and then a banking economic team. So that gives us a pretty broad view of the world and what is happening. And personally, I've also, in my previous life, so to say, been a global CIO of asset management companies, and that helps in looking at the real economy through the spectacles of financial markets.
Perfect. Thank you very much, William. And finally, Serdar, Head of Corporate Governance at the OECD. Your turn.
Thank you, Oliver. Thank you very much for the invitation. I'm really happy to be here. I'm heading the Corporate Governance and Corporate Finance Division of the OECD, and division has mainly three responsibilities. One is on corporate governance, more legal regulatory aspects and how countries regulate their corporate governance environment. The second is corporate finance. In our terminology, it is more non-financial companies access to market-based financing, use of corporate bond market and public equity market. And the last area I'm responsible for is this governance of state-owned enterprises and their financing related to the state-owned companies. Thank you, Oliver.
Perfect. Thank you so much. And for everyone listening, Serdar's prepared an outstanding presentation on capital markets and corporate governance practices, which I think very much helps to set the scene for the rest of the webinar. So without saying too much and trying to steal your thunder, I think I'll probably just hand straight over to you, Serdar, to get into the presentation. So floor is yours. Go for it.
Thank you again, Oliver. The presentation, as you see in the title, is I will try to focus on the implications of the crisis, like first during the crisis, but also some ideas, some discussions we are having at the OECD on potential post-COVID realities. Of course, as Oliver said at the beginning, we don't really know when the post-COVID world we will enter and start, but still we are already, of course, like everyone else, we're already discussing the impact as of today, but also potential implications going forward. So before, maybe as I kind of describe what are the main responsibilities of the division I am heading. So the key responsibility is, I don't know if maybe most people don't know the OECD structure. So we have key committees that kind of all together becomes the OECD. And these are like around 20 something key policy areas. One is corporate governance, there is environment, there is nuclear energy, there is health, of course, economics, so many different areas. So the committee means the OECD's 38 member countries, they are the decision-making body on this policy area. So they come together regularly, they discuss and agree on international standards or some policy issues. And as the head of the division, our division, our main responsibility is to serve this committee and they prepare their decisions, etc. So the committee's key function is it is the custodian of the G20 OECD principles of corporate governance. These were developed by the OECD in 1999 originally, but then in 2015, they were endorsed by G20 leaders summit, and became G20 OECD principles. So what the committee does, they keep them updated, they focus on, they monitor their implementation, and they also promote their implementation. They are also one of the Financial Stability Board's key standards. Again, OECD has 38 member countries. For example, China, India, South Africa, they are not OECD members. But since the principles were endorsed by G20, so this committee, different than a bit most other committees in the OECD, has a special structure. All G20 OECD FSB, in total, not again 38, 50 countries are members of this committee and work together on international standards for corporate governance. And what are these principles? So basically, maybe you may have not heard about them or not involved in any work related to them, because these are basically public policy principles. So their audience is policy makers, is the stock exchanges in some cases, it's the regulators in some countries, justice ministries. So whoever at the national level regulates or work on the regulatory or legal framework on corporate governance, this is the audience. So what they are about, they are mainly about governance of listed companies. So around 46,000 listed companies around the world, and they are more than 300,000 subsidiaries. I mean, they are approximately, as you may know, responsible for 1/3 of the world GDP. So this is about how governments should regulate their corporate governance framework for listed companies. We have another instrument which is specifically on SOEs, state-owned companies, but it is not only listed, it is both listed and unlisted state-owned companies. This instrument is mainly about listed companies. What they focus on, they have mainly three kind of key areas. One is the legal and regulatory framework with respect to shareholder rights, board responsibilities, and then the first is, so let's say, more legalistic approach areas. The second one is on mostly on the disclosure, both financial and non-financial disclosure. And the third one is more related to capital market areas, more like cross-listings, price discovery, functioning of the stock markets. And what happened during the COVID or following the COVID crisis, OECD, this committee, all 50 countries, they met virtually in April last year, but then also there were some other in-person meetings. They decided that these principles need to be revised, taking into account the COVID developments, the lessons from the crisis, but also some long-term structural changes since 1999. So we should adapt, we should revise these principles. What we did from the OECD Secretariat side, we have developed two reports. One is the future of corporate governance in capital markets, following the COVID-19 crisis report. This was released in June, together with the OECD Secretary General and the Italian Finance Minister, ahead of the G20 Finance Ministers meeting in July, and then OECD Corporate Governance Factbook. So I will talk about the Factbook a bit. These are kind of the two main publications I will also present today, but they are guiding the revision of this instrument, this international legal instrument. Based on these reports, committee agreed to revise. Then, of course, since it is a G20 instrument as well, we went to the G20, and in October, Rome Summit, G20 leaders endorsed the committee's decision. We started to work last week in Paris. The revision, the work started. We will work on it over like 15, 16 months period, and hopefully in 23 they will be presented to G20 leaders again for endorsement and for implementation. So I mentioned already the Corporate Governance Factbook. This is one of the key publications we have developed to support the review. This is every 2 years we issue this. It's a very rich, to be honest, it's our flagship publication. What basically it does, it looks at how countries implement these corporate governance principles. It's 250 pages, compares, it's not ranking, it doesn't rank countries, but what it does, it compares 50 countries, the largest 50 markets in the world, all OECD G20 markets, and looks at different, from shareholders' rights, let's say from disclosure, from boards, from diversity, many different aspects. They compare how countries regulate their corporate governance framework. It's a very rich publication and widely, especially by policymakers and of course also for academic research purposes, widely used. In this edition, we also had 3 new topics: audit, oversight of audit, proxy advisory services, and gender balance on boards. And the second one I mentioned is the Future of Corporate Governance report. As I said, we launched in June. This report kind of sets the scene for the OECD's discussion on the revision of the corporate governance, global corporate governance standards. The report identifies 5 key policy messages. The first one is making equity markets support recovery and long-term resilience, adopting the corporate governance framework. This is more again the core corporate governance framework. The third one is ESG risk management. Fourth one, excessive risk-taking in the non-financial corporate sector. And the fifth one is insolvency and restructuring frameworks. Now I will kind of try to a bit talk about all these 5 areas a bit in detail. So the first one is the equity market. I mean, this committee, again, the OECD's work is from a public policy perspective, and who we have in these committees are usually the securities regulators, authorities, financial services agencies, or treasuries in this group. So what they have one kind of a concern now, what we have observed is huge kind of a delisting wave, if I may call, over the last, let's say, 10 years from the stock markets. So 30,000 companies have delisted from the stock markets globally, especially in the US and Europe. Again, maybe you know, there were 9,000 listed companies in the US 20 years ago. Now it's at less than 5,000. If you look at the figure on the left-hand side, the net listing. So of course, one thing is companies leave, and for many companies this is natural, but also other, how do you kind of, at the same time you have new companies coming to the market. So normally, until last 2, 3, 5 years, we always had more companies coming to the stock market globally than leaving the stock market. So we almost a net increase in global number of listed companies. But what we are seeing in the last 3, 4, 5 years, there is a decline in there is a net decline in the number of listed companies. The figure is all like global. If we exclude Asia, emerging Asia, especially China, but some other markets, it's even worse. I mean, for the OECD area, for example, there's a net decline over the last 10 years, and it's a much bigger decline than what we see in the figure. Of course, one part of it is the cost on the right-hand side, underwriting cost, which is the, let's say, largest direct cost. But there are also other kind of issues that generally the committee is concerned with respect to, in particular, the smaller companies' access to stock market, how to promote their use of public equity markets. And again, especially in a COVID situation when there's lots of discussion on how to recapitalize, because we will discuss more on the debt side of it. Many companies have increased their leverage during the crisis, and thanks to also the government support and central bank policies. But now there's a bit of a discussion how to focus on recapitalizing the companies, also using the public equity market. So based on that discussion, so what was the agreement? The overarching policy objective will be facilitating access to equity markets. Of course, one aspect here is very important, this new business model issue, because I mean, over the last, let's say, last 150 years, all big transformations, from for railways, then maybe car companies, then telecom, in 1990s, maybe the internet, tech companies, capital markets have always played a very important role in big transformations. And now what the view is, there is another, I mean, we are in a new phase of a big transformation, which is both digital and green transformations. And there is a kind of a strong focus that capital markets also play a very important role in this transformation. Only public funding will not be enough. Everyone agrees that there needs to be more private financing, and capital markets should play this role in these transformations. In terms of the core corporate governance issues, there are of course many issues, but I will just maybe touch upon some key elements. One is the ownership structural changes. So our model, the discussions historically, of course, it's not everywhere, but as you know, the corporate governance discussion has been dominated mostly by the US, Anglo-Saxon, UK models, and which is more based on a dispersed ownership structure. So companies have small shareholders, no one controls, or there are not many large shareholders. And of course, we knew that this was not the case in many European countries, but still, what we see 3 parallel trends at the same time that is increasing ownership concentration in the listed companies around the world. The first one is the increase in Asia. Now, today, I mean, you may know Vietnam has more listed companies than France, Germany. So China has the highest number of IPOs over the last 10 years. And there are most markets that were kind of very dynamic over the last 10 years were markets where there is an ownership concentration in the hands of company groups, and in some cases in the hands of state ownership. But so at the same time, so there's a bit of a composition change of listed companies, which increases the ownership concentration. But also we know that some large institutional investors have they have become bigger than like, let's say 10, 20 years ago, and they hold significant shares in individual companies. So there's generally a concentration. Of course, on the left-hand side, you see as of end 2022, 43% of public equity in the world is in the hands of institutional investors, 10% corporations, so corporations holding equity of other listed companies, public sector, which is basically the state, 10%, Again, this is not a very small number. I mean, if you consider compared to 10, 20 years ago, it's a very big number. Public sector now holds 10% of public equity, state ownership, and we call strategic individuals. You can usually think them together with the corporation. So these are big families. This is the distribution. And ownership structure, of course, have very significant impact on corporate governance arrangements from a public policy perspective. So now we are trying to understand these changes and what will be their potential implications. Of course, during the COVID, there were discussion of executive remuneration, that some companies may have rearranged their executive remuneration metrics and to kind of a bit considering the impact of the COVID crisis on their revenues, and that's one of the discussion points. And also there are more like how to use technology to do annual shareholder meetings or other technological tools to facilitate shareholders' engagement with the companies. So the policy areas they focus is, I don't want to read all of them. Of course, crisis management, as always, after one crisis, but this time risk management. But this time a bit of it focus is a bit different because it was not like a one-off event. It's a long, I mean, at least almost 2 years now. It continues. So not just how to be prepared for a crisis from a risk management perspective, but also how to manage the crisis itself. That's one aspect that's the focus. Of course, audit, stock price, manipulation, insider trading, these are all regulatory issues that there's the current focus. And of course, again, based on what I said in the previous slide, the link between executive remuneration and long-term company performance, there's again a call for let's have a look at this carefully, what have companies done during the COVID crisis and how should this affect our regulatory framework. And the third topic is ESG. It is not a surprise. The crisis has really brought increased attention to the importance of identifying risks, unexpected shocks, and ESG issues have, compared to even 2-3 years ago in the public policy community, it has received significant attention, so big focus. What we are doing is a climate first discussion, so because it reduces the complexity than discussing an entire ESG issues. So we started last week with change discussion, and we will continue with an ESG discussion. The focus, it is not the principles, the OECD's focus is not only on the disclosure side, there's also the shareholders side and the board. So disclosure related to ESG, what should be the role of shareholders, kind of proposing agenda items, voting, or what do they have a say on sustainability issues, climate issues, and of course the role of boards, how to achieve these objectives. And the big discussion in the public policy community is the financial and double materiality discussion. Some countries, as you know, they are more interested in or the traditional financial materiality concept that the disclosure or even other ESG issues should mainly focus on things that have a financially material impact on the company. On the other hand, others say no, double materiality is also important, so they should not only look from a financial impact on the company, but also from an impact on the society, on the environment. This should also be disclosed. What the figure shows here, because we have recently done this analysis, so using the SASP's mapping, the materiality mapping, we have looked at so the first one is the emissions, the second energy management. Basically, the first one is, I don't know if you're familiar with Scope 1 emissions, and the second one is Scope 2 emissions. So what the figure shows us, that climate change is already a financially material information for 60% of listed companies as of today even. So a bit the focus now is, again, there is a big discussion on financial double materiality, but what we say is for climate change, specifically on the E aspect of ESG, we should probably leave this discussion behind us because we know that it is financial material almost for every company, listed company in the world. For other aspects, especially for the S, it will probably, this discussion will continue and we will see how we will incorporate a consensus among 50 countries into the new global standard. And in the following area is from maybe a corporate governance point of view, it may not always kind of the main issue that we are discussing, but what we have been doing for years is we have been following the corporate bond market very carefully. Of course, as you all know, there has been an increase in issues by non-financial companies, corporate bond issues by non-financial companies. So our own calculations almost doubled now in 10 years, the outstanding amount. But more importantly, what we have seen, the quality has declined. So we have created this index also thanks to using the definitive data on the ratings. So we have created this global corporate bond rating index. This is basically the entire corporate bonds issued everywhere in the world, average rating. And what we see a long-term decline in the quality of the bonds. And then you see the kind of the fluctuations. So some changes are more cyclical, of course, as we always say, but also at the same time, there is a long-term trend in decline. And that's one issue. Maybe we will discuss probably more about this in the panel. But here our concern is, okay, companies issue this bond, especially low-quality companies. So what do they do with this money? So what we have identified increasingly, many companies in the low-quality segment, they are issuing bonds and using them to finance buybacks. So what, of course, the impact is both your debt increases, your equity declines. So there is a kind of a bigger impact on the leverage levels. And this is one of the areas we are focusing on now, how to address. From the perspective of the OECD standard principles, of course, it is the management and board who are best placed to decide on the optimal financing structure of the company, but of course they should at the same time ensure that proper risk assessment procedures are in place. So that is kind of the area we are currently focused on. And one aspect, the last one in the report and in my presentation, is insolvency and restructuring discussion. One aspect is related to the previous point, because in some markets, of course, corporate bond markets functioning very well for years, and there's a bit of a legal clarity, contractual clarity. Everyone knows there's the disclosure requirements, but especially in some emerging markets, where in the past there were not that many issues by non-financial companies, and there was some cases over the last few years that the transparency of the contractual conditions, the covenants and the bonds contracts were not transparent enough. There were some cases that, from a listed company perspective, of course, why we are interested in this, because half of the corporate bonds by non-financial companies are issued by listed companies or their subsidiaries. So this has become an issue that affects the governance and conditions for listed companies. So the transparency aspects of that bond contract is one area, but the other one is of course, the crisis hit. There was kind of an expectation that there will be a lot of insolvencies, restructurings, defaults. It happened a bit at the beginning, but strong central bank and government interventions, it kind of stopped this trend. So we, even in most countries, we have even insolvencies lower than the trend numbers. But this doesn't mean that risk is not there. I mean, we had a bit of a similar case after the 2008 crisis. Maybe first 1 year it was reasonably better, but then in 2010 with the euro area crisis, and then in some countries the corporate sector started to struggle, which almost lasted for 5 years, and then OECD, as you may remember, have been talking about zombie dominance in some European, zombie company dominance in some European countries. So to prevent a similar situation, we think that there should be a focus on improving the governance of insolvency and restructuring processes, and this is one key areas we are going to focus. Thank you very much, Oliver. This is, I think, all on my side. I'm here, and again, it's a great opportunity to present OECD's work to the audience today.
Perfect. Thank you so much, Seda. That was excellent. Now, I think it's time for a poll. So I think just to engage the audience, I'm going to be asking this one poll question. And the question is, what do you think will be the biggest challenge for business over the next 12 months? So in your opinion, will it be return to lockdowns? Could it be withdrawal of government financial support? Or is it dealing with net zero and other ESG commitments, or something else? So I think I'll leave that on there, and please vote on whichever one you believe is best. I think following that, what we'll do is we'll sort of have a panel interview where we'll talk about very sort of topical things in terms of COVID impacts on businesses, stuff relating to ESG, stuff related to government debt, winding down, financial support going forward, all very interesting. So I think I might do is everyone has voted. I'll just slide that over. Oh, dealing with net zero and other ESG commitments comes out on top at 54.5%. That's completely and utterly unsurprising given we just had COP26. I think we'll definitely get into that conversation, which Claire will very much likely lead now. So without further ado, what we'll do is we'll go through 4 topics. And the first one will be how companies effectively are raising funding, both currently but also in future. So what I've done, which has equities versus corporate debt, and as Seda mentions in his presentation, loads of companies have been very much, jumping on a bandwagon and issuing loads of corporate bonds to very much sort of take advantage of government stimulus packages. Now, obviously, they're winding down. So I think the question is, and I think I'll probably just continue with you, Seda. So given that, government and central banks are winding down corporate bond buying programs, what do you think will be the overall impact on companies and all sectors? I mean, do you think that they'll revert to raising capital instead in the equity markets, or do you think they even need the additional capital? What are your thoughts here?
Thank you, Oliver. Thank you. Very good question. One thing maybe I need to also clarify, taking this opportunity, what we show in the report, of course, I mean, the governments or central banks, the public policy makers' main focus during the COVID was keeping the markets open. Markets from trade, markets, but also capital markets, so that they function and companies keep financing them. And they were very successful. Markets were open, both the debt, equity market, issuances were historically highest number. But what we show in the report, which is, I think, different than the overall picture, the problem is, for example, in the corporate bond market, newcomers, so first-time issuers in the corporate bond market, has declined the historical low levels in 2020 and 2021, and a bit similar to the equity market. So what we saw, the companies are using, but the ones that are already in the market, they have access to the market, are tapping the market a lot, but the ones that are not there, that are new to the market, or they are new companies or whatever, they didn't have the same opportunity. So there was a kind of uneven access to the capital markets. This is why we are concerned how to make capital markets also functioning for newer, younger, or more innovative, or companies that did not use the capital markets. Right? So I think on the large corporate sides, it's mostly, of course, a corporate finance decision. I mean, they have access to the market, they know what they are doing. So they, but on the lower segments, is a bit of the challenge. As you may remember, in 2018 was the only year, almost like the last 20, 30 years, except the 2008 crisis, net corporate bond issuance by low-quality companies was negative globally. It was the only year the net issuance was negative. What happened in the second half of the year? There was an expectation that the central banks will not continue the easy monetary policy, so almost the high yield market was closed for a few weeks, even months, for many companies. And then what happened? And then central banks, early 19, kind of clarified that they will continue the easy monetary policy, and the markets open again and issues continued. So the focus now is not maybe the ones that already have access and they can do what they want to do, but more on the bond side, more on the low quality ones, like the companies below the investment grade. I mean, how to keep they have access to the market, like a continuous access, so that we don't end up in a difficult situation, I think. And on the other hand, on the equity market, how to provide access to the smaller, new, innovative companies so they can use this financing for the transformation, the ESG green transformation needed. Thank you, Oliver.
Mm-hmm. Perfect. And what about you, William? Do you broadly agree with what Seda's saying? What about some of the assessments from your sectors, for example?
First of all, the reaction of the central banks and the governments, but starting with the central banks, was of course of fundamental importance. In particular, I would say in the US, because what we normally see during a recession is that you have an excess bond premium that is developing. That is a premium which comes over and above the best possible estimate of future defaults. That has been avoided, and as a consequence, as was said, the market stayed open. I think that has also set a precedent, which in a way from a risk control perspective is positive, because it means that bond investors, corporate bond investors, will be more relaxed to hold on to their positions in case of a major growth slowdown, which is not the current phase we're in, of course, but they will hold on because they will expect that when push comes to shove, central banks will again do the same thing. So that's point number one. Point number two is possibly what has played a role is that some companies that previously had not yet tapped the corporate bond market were reluctant to do so, fearing perhaps a kind of a phenomenon of new kid in town having to pay an extra spread, and I suspect they have relied on bank financing. Then, as you know, banks have played a very important role in making liquidity available for the treasury needs of companies, and that, of course, has been helped a lot by government support in terms of providing credit guarantees up to a certain level, not 100%, of course, but up to a certain level. So I think what I'm looking at now going forward is more the policy normalization perspective, what that will bring. And there is kind of an underlying nervousness that you see developing. Not that is getting dramatic, but nevertheless struck to see, for instance, that in the US, high yield corporate bond spreads have been moving gently higher. They are still in the absolute pretty low, but nevertheless gently moving higher. So that's really something to keep an eye on. Because at some point that phenomenon would accelerate if there is a growth scare developing. But let me re-insist on the fact that if you look at the foreseeable future, also referring to the OECD economic outlook published this week, that is not on the horizon yet.
Okay, perfect. Thank you so much for that. So the next topic effectively is looking at shareholders' bottom line and a sort of a contrast with ESG. So obviously, when the pandemic struck, I think businesses, many sectors were really quite hit badly. So if you sort of look at the chart, you can see that profits, just generally as a sort of proxy for company health, especially last year, really sort of took a massive dip. Now they're obviously recovering somewhat, but then again, at the same time, you've got, the ESG commitments, which were there before, but obviously are now slowly very much developing, especially, after COP26. So I think really the question is, and Claire, I'm going to ask you this specifically. I mean, how much do you think ESG now will play a factor in corporate governance? And if so, do you think they'll be stronger in certain sectors or for certain businesses? What are your thoughts on that, Claire?
Thanks for the question. I think, it's a really important one. And I'd say, absolutely, I think it's going to be a really strong importance, and I think there's a real connection here to trace back to the recovery of the economy. The global economy is beginning its recovery, as we've been talking about, following the global pandemic, but the recovery is uneven. And I think, globally, you've got challenges in terms of sort of the different levels of economic growth forecasts you're seeing from, say, the developed economies to the emerging and developing economies. There's other challenges around commodity prices, supply chain disruption, and then also most imperative amongst that as well is that we recover, but we rebuild it in a way that's more resilient, it's more fair, and it's sustainable. So I think changes are happening faster than ever, really. It's reshaping how people are living, how people are investing, and understanding how investment portfolios as well are going to be impacted by these changes. So I think we believe that ESG factors are becoming increasingly mainstream, and that can be used to drive investment, outperformance, and investment strategies are incorporating in ESG strategies, and so therefore we yes, we really believe that ESG is going to continue to play a major factor in corporate governance. If you actually hear the CEO of the LSE PLC business speak, she talks about ESG becoming BAU, and therefore something to address your question about which sectors. Well, actually, therefore, if we treat it as becoming BAU, it's relevant for all businesses, regardless of sector or size of the company. And that management of ESG risks and opportunities, I think, is very relevant to that long-term success of firms, and I think stakeholder expectations are rising in this area. We looked at some of the asset owners and how they're integrating sustainability into their operations, and we're seeing some of the biggest funds in the world now switching to benchmark their core passive portfolios against FTSE climate and sustainability benchmarks. So they're feeling really the pressure to act, and there's interest in doing so. So I don't think there's no doubt really that in order to deliver strong ESG strategies, the importance of capital is going to really be fundamental to that. And I think we saw that the pandemic also has shown the value of needing to have well-operated and liquid capital markets. That throughout the pandemic, listed companies utilised capital markets to strengthen their balance sheets, as well as funding growth and funding innovation. But actually in London, we had one of the strongest halves of the year in 15 years, with 43 IPOs raising just shy of £9 billion. And that had a very strong focus on both sustainability and technology, both essential components for the recovery, and therefore, I think answer that question of that, ESG is just paramount in this.
Perfect, thanks. William, I'm going to ask you to follow that to see if you've got anything to add to that.
Yeah, money is power, and shareholders are demonstrating that, and that's good. But also company management is very much aware of that. And what's interesting is that we have seen during the sell-off in March last year, there has been an academic research on that. During the sell-off, what was the profile of companies that resisted better than other companies? And the sample was something like 6,000 global companies, meaning companies working in different parts of the world. And what was interesting to see is that neutralizing for sector composition and other things, that companies with complex supply chains suffered more in the drop in the markets than companies with easier to understand supply chains. But then companies that paid a lot of attention to ESG actually were more resilient than companies that did not pay a lot of attention to that. Now that I think is very revealing, because you could argue that certainly in its initial phase, the assessment of the COVID-19 shock was not very much associated with, let's say, ESG considerations. Only later it ended up becoming linked, quite rightly, but not initially. And nevertheless, we saw that bigger resilience. So my interpretation there is that companies that pay a lot of attention to ESG are considered to be less risky, and that's important. And I think companies will take that on board, will take that into account in developing their strategy on what they're doing specifically on ESG, because of course it will have an influence on the cost of funding.
Perfect. Thank you very much for that. Okay, so sticking with the subject of ESGs, because it's very topical. Claire, I guess you went to COP26, so you probably saw everything pretty much frontline. So I think this is really sort of all about, business kind of really spearheading, a lot of the ESG sort of commitments coming out of that. So if you look at the chart here, you'll see this is taken from a company called Beyond Ratings, who also are part of LSEG. And you'll see that in certain markets like Europe, for example, Americas, they do score quite well on ESG factors, but I guess in other areas like Asia and Africa, probably not so much. And we could probably debate, a lot of the characteristics of that. But one thing which actually did come out of COP26, which did sort of caught my mind, is that there was almost this implicit agreement that so there's 2/5 of the world's financial assets, so something like 130 trillion, underneath the management of banks, insurance companies, and pension funds. So they signed up to those 2050 net zero goals as a result of COP26. So Claire, given you were there, I mean, what are your thoughts about this? I mean, do you think something like that initiative will really sort of spearhead, investment in green projects, companies? Do you expect that to be, quite a good initiative for leading the green economy? What are your thoughts?
Thanks. Look, I actually think that it's quite an exciting time, to be honest. I mean, we as LSEG, are founding members of Gfans, so we are committed to accelerating the decarbonisation of the economy. We've set our own net zero targets as an organisation as well. So we've got, strong ambitions to be leaders in this area and to support our clients and customers along the journey. But I think, the market is moving, but it is still early days. So I think we need to reflect that. Having said that, the asset owners are quite well advanced in this area, because before the launch of Gfans, it was only really investors who had a clear way to join this movement. But there was no standardisation really of what a credible net zero commitment could look like for other firms like the banks, the insurers, or financial services providers like stock exchanges and data providers, etc. So I think what's important now is that all segments of that financial sector can make this commitment, and doing it in a very collaborative way, which is what I think the market and industry needs. So uniting it helps sort of mobilise, I guess, and activate the entire value chain and drive systemic change, which is needed. And I think whilst those banks and insurers and others, were newer to this, the important point is that we're on the journey, and that everyone is agreeing to measuring progress and setting targets and the need for transparency. So we should, start to be seeing consistency and coherence across different global regulatory frameworks, disclosures, methodologies. And I think also what's quite important here to reflect upon is that the size and diversity of how sort of Gfans has come together is quite important, because this isn't just sort of a global north membership. You've got representation from all areas across the world. You've got Brazil, South Africa, Kenya, Caribbean, many others as well. And I don't think we can get to global net zero in a niche way. We've got to look at how we transform that entire financial system, and along with all the different sectors in our economies, whether they're green or otherwise. And so I think that momentum that's building with Gfans has demonstrated that financial services, the financial system has got to be a really key part of mobilising the global climate change. And that definitely came across at COP as well. And it isn't, policymakers and governments acting in silo and alone here. This is about commitments that have been made, and the huge scale of investment that's needed actually to be able to fund this transition. You've got to get that capital coming from mainstream finance and industry as well, and stepping up to be leaders here as well.
Perfect. I would agree with all of that, definitely, for sure. Okay. This is the final topic. So this one's all about government debt and economic growth. And what's, I think, quite evident just from looking at this chart is that I think government debt as a percentage of GDP, I think rightly so, really sort of ballooned over the lifetime of the pandemic currently. And I think we're sort of at a state now where some governments, I guess at least before the Omicron variant sort of, unleashed itself, they were starting to think about how they can start winding down, a lot of their government stimulus packages. More recently, the US had signaled that they wanted to sort of cut back on their bond buying programs, for example. But there is a sort of issue around what that potentially could have in terms of ramifications for economic growth. So I think I'll start with you, William. I mean, as the chief economist, do you believe, what do you think the impact of winding down this government stimulus will have on economic growth? Do you think, certain countries will be more immune than others, or which ones will be more likely adversely affected? What are your thoughts?
Well, there is already a distinction to be made between the European Union and the US. According to European Commission calculations, we will still have a positive fiscal impulse this year and next coming from Next Generation EU to the tune of about 50 basis points. So 50 basis points of GDP growth would be caused by that impulse. That is a smaller impulse than what we have seen before, but still a positive impulse. It's smaller, and this is also quite logical, considering that the private sector demand growth is now so strong and will continue to be strong, although it should slow down somewhat, but still will continue to be strong. So I look at Next Generation EU as something that is accompanying the recovery, but is really targeting long-term growth through the impact of projects on potential GDP growth. In the US, the expectation is that the fiscal impulse will actually be negative, will act as a headwind. This is an important point to keep in mind when one is making an assessment of how quickly the Federal Reserve would consider to tighten monetary policy, because of course it will have to take on board what is happening with the influence of fiscal policy on the economy. I think beyond that, the key point, as your charts clearly show, is that we have made this huge step. But I refer to this as a kind of walking a stairway. The majority of countries, if you go back over the past 3 decades, are walking a stairway of increasing public sector indebtedness. That is, that most of them do not have an ability to drive down public sector indebtedness after it has been increased due to recessions. That means that it brings us in a situation where policy leeway is becoming smaller and smaller. And this is a concern you mentioned to the Omicron variant. Just imagine for a second that we would be in a kind of an endemic uncertainty. So that means that uncertainty continues to be there, and it's also vindicated by the fact that now and then you have new waves of infection. So then the question is, what does that mean? Because it will be pretty detrimental on certain sectors that are sensitive to the health situation, to the health risk. And what would that mean for public finances? Point number one. But point number two, let's keep in mind that you have 2 other major issues, challenges for public finances, which is that accompanying the financing of the energy transition. That's point number one. And point number two, of course, population aging and what it does to public finances. So major challenges are there. It means that the debate that we will have in the European Union on the new fiscal governance, the follow-up of the Stability and Growth Pact, will intellectually be a very interesting one, but will practically be a very challenging one to come up with something very ambitious, because of all these big kind of tasks which are waiting on us and which are really huge challenges. It's very difficult as a government, I think, to go to the audience, to your audience, meaning to your people, to your citizens. We are going to cut the budget deficit when there is no external pressure. And that's the big difference between today and the 90s in Europe, when we were all getting ready for getting in shape to join European and Monetary Union, Economic and Monetary Union. Then you had external pressure. Now that external pressure is not there, so it means to be tough on fiscal policy becomes very, very difficult.
Perfect. I think, Serdar, in the short time we have left, you have like 1 minute of input you'd want to maybe add to that too?
Thank you. My focus, as you know, is on the corporate side, not on the public finance side. But what William said, the OECD issued the economic outlook, the new one, yesterday only. And there are, I think, just the two messages. OECD, I mean, we are not concerned about the public kind of debt or spending during the COVID, related to the COVID, both from the health expenses, but also from the supporting the corporations. And so the important point is, of course, is where you spend the money, especially education and infrastructure. One OECD message. The second is one day or when governments the support programs, it should be transparent, it should be predictable, that we don't end up in a situation like, let's say, after the euro area crisis, that economies are dominated for unviable, unsuccessful companies for years to come. It should be planned and organized very well. Thanks a lot, Oliver.
Okay, perfect. Thanks for that. Again, in the time we've got left, because as ESG was really quite topical, I just wanted to let the audience know, many of whom who are quite big users of Refinitiv data stream, that we've added over 750 ESG time series. So the 3 boxes below pretty much just show some examples of the sources we use. So on the environmental side, we've got everything you can think of in terms of emissions, adaptation indices, and KPIs for climate. On the social side, we've got a whole bunch of municipal social indicators, for example, prosperity and hunger indices, and on governance, sources from, for example, the World Bank and IMF. So I think if any of you are interested, definitely feel free to get in touch, and we'll put you in touch with an example of a demo for you to be able to interrogate that data set. Okay, so I think just in terms of the last minute or so, I think what I'll probably do is, because we don't have too much time for questions, please just send in your questions, and I'll make sure that all of them have answers. But for now, what I think I'll do is I'll leave it to Sophie to talk about next steps and to formally close the webinar. So thank you very much to our speakers. Thank you. Sophie, over to you.
Thank you, Oliver, and thanks a lot to all of our speakers today. Please take a few seconds to reply to the survey that appears on your screen right now. The slides and the recording will be available shortly. You will receive them by email, and they will be available on our platform. But we hope you had great time during this webinar, and we hope to welcome you again soon. Thank you very much, and goodbye, and thanks again for attending.
Thanks.
Thank you.
Thank you, everyone.
Bye-bye.
Thanks. Thanks, William. That was
Bye-bye.